Peter Mauthe, and I'm making this presentation on behalf of Trademark Capital Management. This is a quick summary of the September 23 Fed meeting. And they have, at this meeting, which concluded yesterday, the Fed has decided to keep Fed funds target rate unchanged. Now, this is not really a surprise. The market had pretty much expected this. They also made it very clear in this meeting, as they have in most recent meetings, that the federal funds rate is going to stay high and likely stay higher longer than most people expect. Importantly, the market expects in the coming 12 to 15 months, one more rate increase of 0.25%. Now, I'll show you a couple charts in just a moment that'll help explain why this is likely going to be the last of the Federal Reserve interest rate increases. The market is also anticipating that the GDP, the gross domestic product, through 2024 will remain fairly positive, simply meaning that they're not expecting a recession as many economists have expected. Unemployment is also expected to increase, but only modestly, up to a little over 4%. Now, historically, 4% was considered completely full employment in the United States until we broke below that level in the last 24 months. Next year, the market was expecting 4 rate decreases, but now is expecting only 2 rate decreases. And based on the Fed's testimony or statements yesterday, that may still be in question and may be amended by the market expectations early next year. Now, let's take a look at 2 charts real quickly to explain where the Fed is and where the market is. The first chart is of the federal funds rate, the target rate, which is in black. And you can see the 2-year Treasury note yield, which is in green. Now, this chart was prepared by McClellan Financial Publications, and it is current. Now, the current federal funds target rate is 5 to 5.25%. And so it's now in the zone where it is above the 2-year rate. And this is important because once the Fed starts to exceed the 2-year Treasury rate, it is frequently overstretching its need to increase rates. Now, you can see the red arrow towards the left of this chart, which goes back to 2006 and 2007, where the Fed kept raising interest rates, yet the 2-year Treasury note, which is determined by the marketplace, not by the Fed, stayed at about the 5% level. Now, this went on for a prolonged period of time, but in the end, the 2-year Treasury note proved to be the more valid indicator of where interest rates should be. So once again, if the Fed raises rates further, the 2-year Treasury note is likely to stay under that federal funds target rate, suggesting the market or the Fed has gone too far. Another view of this, by the way, is just in this chart, and you can see why at this level, this 4.5 to 5.25% zone on the 2-year Treasury has proven, at least in the last 20 years, to be the target zone that has had an effect on the economy to the extent that the Fed has wanted. The last time we had this rate was in 2006 and 2007 at the top of the housing boom, an economic boom coming off of the financial crisis, or this was leading into the financial crisis, but after the tech bubble burst in 2000. And so, however, it's also noteworthy here to understand that at that time, we spent a year and a half in this 4.5 to 5.25% zone before interest rates had to decelerate, and they decelerated in a hurry as the financial crisis unfolded. Now, obviously, the Fed has hopefully learned from this experience it is not going to cause such a financial crisis this time around, and likely won't, since we have this in our historic database now. But nonetheless, this zone is going to be a formidable zone for interest rates to consolidate for a prolonged period of time. And the chances are the Fed will be successful in slowing down inflation with interest rates at this level. That's it for this week. If you have any questions, don't hesitate to reach out to us at trademarkcapital.com, and you can email us or phone us. The information is on the contact tab.